Okay, let's continue with this example by looking at the 2018 scenario. Here are the assumptions for 2018. We have a present value of prior service benefits granted January 118 of $42,000. So let me explain what that's referring to. This is an example wherein there is an amendment to the plan document, which led to determining that prior service costs were not calculated appropriately. Again, perhaps it was a change in benefit or vesting period, or a change in what the percentage of salary that becomes a benefit. But the bottom line is, at the beginning of January 1 or 2018, there was $42,000 of additional service benefits that should have been recorded in previous years, and that's a present value number. All right, then our annual service cost for 2018 is $28,000. We continue to have a settlement rate of 2018. We had an actual return on plan assets that was $31,000. We contributed $29,000, paid $24,000, and during the current year, we amortized $17,500 of the $42,000 in prior service costs. So let's go to the 2018 pension worksheet. You will notice that we start out with the beginning balances from the previous year. And so that the plan assets represents what we ended 2017 with, as does the projected benefit obligation, as does the pension asset liability. Okay, the first thing we're going to do is we're going to adjust that beginning balance for the prior service costs that we computed. And that's going to increase our projected benefit obligation, because those are additional amounts that we are technically liable for. And then, as I had mentioned in the original introduction, FASB says you don't have to hit a single year with that full adjustment. Put it in other comprehensive income and then amortize it. So what we're doing here is we are debiting other comprehensive income for the $42,000. And then again, acknowledging the fact that the PBO would increase by that dollar amount. And had we recorded those in the past, we would have actually started January 1, 2018 with $533,500. Okay. So let's go over to our annual pension expense. We'll go through it pretty much the same way we did in 2017. The annual service cost comes from our assumption page, $28,000. The interest cost is the 7%, but notice it is times the adjusted balance of $533,500. So the $42,000 in prior service cost does play into the amount of interest costs for the year. Our actual return is $31,000. Again, that was given to us. And notice, I should have mentioned this, the service cost, we are acknowledging that will increase our projected benefit obligation on the books of the plan. And the interest cost, we are also acknowledging will increase the projected benefit obligation on the books of the plan. By the same token, the actual return on plan will increase the plan assets on the books of the plan. And again, notice that return is decreasing our pension expense because we're able to offset our earnings against the expense that we would incur. Now, well, we're adding this one item. This was one of those two bottom items on the slide referring to components of pension expense. This $17,500 is an amortization of the $42,000 that we had recorded at the beginning of the year. We'll walk through down the road how we go about amortizing it. For now, just know that the amount we compute for the current year amortization will increase our annual pension expense, and then it will decrease our other comprehensive income because we're amortizing, we're expensing gradually the other comprehensive income. Has no effect whatsoever on the investment, the plan accounts themselves. Those were affected in their entirety at the beginning of the year. Then similarly to last year, 2017, we will credit cash for the amount of contributions we make into the plan, debit plan assets on the books of the plan. And then again, the benefits that we pay have nothing to do with the company's books. It is a reduction to the projected benefit obligation and a reduction to the plan assets on the books of the plan. Now, let's move on down, and what we see is the annual pension expense computes to $51,845. That's an addition of the debits and a subtraction of the credit. We'll credit cash for $29,000. We will make a debit to other comprehensive income for $24,500, which is the net of the original prior service cost and the current year amortization. This number, the adjustment to pension asset liability, is really just a plug to make the entry balance. We'll come down below and prove that it is correct. And we'll do that here. We have a projected benefit obligation at the end of the year of $574,845. We have plan assets of $531,000. So at the end of 2018, we are underfunded by $43,845. And you will notice that equals the beginning balance in our pension asset adjusted by the amount that we need to record in order for our entry to be to balance. And here I just put in a check figure to ensure that this amount and this amount are the same. This is just a calculation of our under or overfunded status, which is what we need to have in the pension asset liability at the end of the year. So let's look at our journal entry. These pull straight from above. We're going to debit pension expense for the $51,845. We'll debit other comprehensive income for the $24,500. Notice there was no beginning balance. We had nothing in OCI related to this at the beginning of the year, which means at the end of 2018, the balance is $24,500. We will credit cash for $29,000 and credit the pension asset liability for the $47,345. And there is our 2018 journal entry with the amounts pulling directly from the worksheet.